Kia ora, and welcome to the CoreLogic Property Market Update for March 2021. This market will not stay away from the headlines. Exceptional value growth, historically low interest rates, tightening credit policy and political pressure are making sure of that. Let's recap a few of those factors then. February was another strong month for sales volumes. Over 9,250 sales in the month meant it was the most active February for 5 years and second most active since 2007. 2016 was the only year to see more property sales. The lift in sales volumes was even more pronounced in Auckland, with February's figures exceeding those occurring in the same month of 2015, previously the busiest February since 2007. Looking back over the last 3 months, there have been over 50% more sales in Auckland than the same 3 months of the prior year. Meanwhile, both Tauranga and Wellington have seen activity drop year on year. Limited properties on the market will be one factor impacting sales in these places, as well affordability constraints. Tauranga ranks as one of the most unaffordable cities in the country, while the long-term sustained rate of value growth in Wellington, with values up 86% in the last 5 years, will be stretching buyers' budgets and progressively keeping some prospective buyers from participating in the market. In terms of recent value growth, 2021 has picked up where 2020 left off. Each of the main centres saw value growth over the 3 months of summer exceed 6%, with Wellington values increasing by 8.3% from December to February. In the provinces, Whanganui values grew by 15% over the same period, while another 7 cities experienced value growth above 9%. The index for Tauranga showed a minor drop for February. However, it's too soon to signal a trend, so we're reluctant to call the end of this growth cycle just yet. With the availability and affordability of credit a key factor in supporting such growth, the outlook for interest rates remains a key topic of focus. Expectations about the outlook for interest rates have begun to change, with it now more likely the next move of the official cash rate will be up rather than down. Although the Reserve Bank has maintained their stance that the economy still requires support, which paves the way for continued monetary stimulus, and subsequently rates aren't likely to lift anytime soon. The best guess is that some form of monetary policy tightening occurs in the second half of next year, but it might be a scaling back of asset purchases rather than a higher official cash rate. Time will tell. That doesn't mean the bank will sit back and let the current rate of property market growth continue though. They have a broadened remit from the government now to help them achieve their housing goals of helping first home buyers and reducing property speculation. And on top of the already announced increase in loan to value ratio limits, requiring 40% equity from investors for new commitments, it's very likely a restriction on interest-only loans won't be far away. The Reserve Bank is currently assessing the situation, but looking across the Tasman, we can see a useful example of a regulator intervening by restricting these loan types. In Australia, over 40% of mortgages were on interest-only terms, but a temporary 30% origination limit on interest-only lending saw this reduced to the mid-teens, and it's stayed there ever since. Subsequently, investor activity and value growth reduced. We expect something similar here, as the bank implements policy to essentially ask investors to make their investments stack up on the current cash flow while also paying off some principal, and not based on expected capital growth. With the possibility of debt to income caps also being introduced, it's clear that the investor landscape is changing. With mortgage investor activity as high as we've ever seen, alongside a noticeable dip in first home buyer activity, the case for the Reserve Bank helping the government out is only getting stronger. The divergence in activity from these two buyer groups is clearly evident in the CoreLogic buyer classification series, with mortgaged investors picking up 29% of all sales in the first 2 months of this year, compared to 22% by first home buyers. Looking ahead, our expectation remains that a slowdown is coming, with signs from our measure of mortgage demand waning in the early February. Though it must be noted, the elevated levels of social restrictions in the last few weeks will at the very least be partially to blame for this. So the housing market is unlikely to drop off the front page anytime soon. It's probably the second biggest challenge facing this government, behind COVID, and I'm expecting to hear more on the policy front over the coming weeks and months. We're in for an intriguing time. To ensure you're across those announcements and anything to do with the property market, make sure you check out and subscribe to our weekly property market podcast. and bookmark the research tab at corelogic.co.nz for all your in-depth property insights. Mā te wā.